This energy crisis could crash the housing market.
European airports are currently drafting contingency plans for an imminent lack of aviation fuel, with thousands of flights already grounded. At the same time, governments across Asia are urging citizens to work from home and carpool to curb national energy demand. These disruptions share a single cause. A massive energy supply shock has been quietly moving through the global system, and it is finally reaching the consumer. To understand why the impact is hitting now, look at the transit time. It takes roughly 30 days for an energy tanker to travel from Middle Eastern reserves to its target markets. During a crisis, existing domestic reserves act as a buffer, masking the physical shortfall from the public for exactly 1 month. That 30-day grace period has ended. The domestic reserves have been drawn down, and the supply pipeline behind them is empty.
Do you think the housing market actually crashes or just slows down?
The stability of the global economy relies on a highly vulnerable maritime thread. That thread has snapped. This vulnerability is concentrated in specific geographic bottlenecks. This is the Strait of Hormuz. Because nearly 1/5 of the world's daily oil supply must pass through this narrow gap, it serves as the primary pressure point for the global petroleum market. To the west lies the Bab el-Mandeb Strait. This bottleneck controls access to the Red Sea, and its closure effectively paralyzes the container shipping routes between Asia and Europe. For decades, the U.S. Navy acted as the guarantor of safe passage through these points. This military presence functioned as a subsidy, ensuring low insurance rates and predictable global shipping costs. As this protective umbrella fails, commercial maritime insurance evaporates. Global energy prices then detach from normal supply and demand fundamentals as the physical risk of transit becomes too expensive to calculate. Crude oil is the foundational raw feedstock for modern life. It is processed into base chemical components, industrial rubber, and most critically, agricultural fertilizer. Because petroleum-based fertilizer is a primary input for global crops, a spike in energy costs compounds at every level of the agricultural supply chain. This makes a surge in grocery prices an inevitable mathematical certainty. The dependencies extend to pharmaceuticals, plastics, and the asphalt used for every road on the planet. During the 1970s oil embargo, these disruptions led to fuel rationing and long lines at gas stations. However, the modern supply chain is significantly more leveraged and reliant on just-in-time logistics than it was 50 years ago. An energy disruption acts as a structural tax levied on the production of every physical good on Earth. Global governments that spent years promising a seamless transition away from fossil fuels are now facing a reality of empty tanks and failing grids. To prevent civil unrest, these same nations are suddenly forced to slash domestic fuel taxes, reversing long-standing climate policy goals overnight. Desperate nations are now firing decommissioned coal plants back up. This regression is a forced response to the immediate need for baseline power and the industrial heat required to process diesel. This panic indicates that recent anti-oil rhetoric was disconnected from the energy density required to maintain an industrial society. Theoretical energy policies are abandoned the moment a geopolitical shock threatens a nation's baseline survival. The physical supply shock creates a direct financial consequence. As energy costs drive up the price of all goods, inflation becomes sticky and resistant to traditional cooling measures. This persistent inflation forces central banks to cancel their planned interest rate cuts. Borrowing costs must stay high just to keep the currency from devaluing further. These sustained high rates place immense pressure on private credit markets. In this sector, lenders hold long-term, illiquid debt that becomes increasingly difficult to value as the cost of capital remains elevated. When investors grow nervous and try to pull their money out, these funds cannot sell their underlying assets fast enough to meet the demand. Funds like Blue Owl have recently been forced to cap redemptions at 5%, effectively locking investor capital behind a gate. Physical bottlenecks in distant shipping lanes create the inflationary pressure that ultimately freezes domestic credit markets. The last decade of anti-oil activism was a societal luxury afforded by a period of relative geopolitical peace and secure oceans. That peace masked a stark reality. Intermittent renewable energy cannot replace the dense baseload power currently moving through contested maritime choke points. Nuclear power provides massive, localized output that functions independently of maritime shipping lanes. Yet, during the peacetime era, this scalable alternative was largely ignored or banned. These soaring global prices represent a structural shift into a more expensive and unstable geopolitical era.